Hello, everyone. This video is Chapter 4, Part 3. So what I'd like to do is to share my screen. Okay. We are now assuming that we have recorded all our transactions during the period, and now we have to perform end of period procedures like adjusting journal entries and closing the accounts, right? And this is going to be relating to a merchandising company. Now you're thinking, chapter 3, go, oh no, now we're in it, right? It's actually pretty easy. There's only one adjustment that's different than what you already know. So let's talk about that, adjusting entries. Generally, the adjusting entries are the same as a service company. There's just one additional adjustment to make the records agree with the actual inventory on hand. Okay, so we're looking for theft and spoilage and basically shrinkage. So this entry involves reducing our merchandise inventory, and any losses that we have through theft and spoilage will be taken to cost of goods sold. So here's what it looks like. To adjust $250 for shrinkage of inventory. It was revealed by a physical inventory count. So even though that in the perpetual system, we keep track of the inventory, we still have to do a physical count to make sure that what our books say is what really is happening out there. We found that there's $250 worth of shrinkage. So we have to reduce our merchandise inventory by $250, and because we sacrifice that, it's not there anymore, we have to debit cost of goods sold. So the entry is simply this: debit cost of goods sold, $250, credit merchandise inventory, $250. Now, isn't that nice? That's all it is. That's the only one you have to worry about. Okay. Let's see, are we going to do this one? No, we're not going to do this one. We're going to blow off the 4-14. Let's continue on. Let's talk about closing entries. Now, the good news is that it's the same procedure as a service business. It's just a little bit more inclusive. So when we close the accounts, we have to close all the accounts that affect net income. So remember in read, close revenues, close expenses. Yeah, that's good. But now we're going to include some other accounts like close revenues and all other income statement credits. And you know what? In our chapter, there is nothing. So you don't have to worry about that. The revenues entry here is going to be the same. Now, when we close expenses, not only just expenses, we're going to close expenses and other income statement debits. And what are they? Well, they would include our contra sales accounts, sales discounts, and sales returns and allowances. Remember, those are debits. So we're going to close those along with the expenses. And you know what? There's even one more. We'll be closing our cost of goods sold account too. So we know that cost of goods sold is an expense, it's a debit. So we're going to close cost of goods sold with all the other expenses there. Okay, let's take a look at it. REID. Okay, so close sales and any other income statement credits that we have. Well, in this book, there's no other income statement credits, so we're just going to take it out of sales and put it into income summary. Remember, sales is a credit balance, So how do we get rid of a credit balance? With a debit. Again, debit sales, 321,000, credit income summary, 321,000. The next one is E, close expenses and other income statement debits. Okay, so what we'll do, we have our usual cast of characters here, depreciation expense, salaries expense, all of our expenses. So we know that these expenses are debits. So we're going to close them by credit. But wait, there's more, because we have to include not only expenses, but other income statement debits. That would include cost of goods sold, sales returns and allowances, and sales discounts. Remember, sales discounts and sales returns and allowances are both contra sales accounts. So they're debit balances. How do we close them? With the credit. Same thing with cost of goods sold. Cost of goods sold is a debit balance, so we get rid of it with a credit. So it's just adding 3 more accounts than what you're used to. Now you're going to notice that you won't even know what to put in income summary until you list all of your debits, your income statement debits, and you add them up, and then you'll plug and chug this income summary of 308, 100. If you add all that up, you'll do this. So when you do your entry, you may put the account in, but you're going to have to leave this blank because you're going to have to build it over here. And then when you add it all up, then the offset is going to go to income summary here. Okay, now the next 2 are just exactly the same as we're used to. The I is close income summary into retained earnings, right? Right now, income summary includes net income. Okay, so how much net income? Well, we know that we have 321,000 in sales in income summary. We put it there, and we know we have 308,100 of expenses and other debits. And because the sales win, it's bigger, then we know that it's going to be net income and it's going to be a net credit balance. So what's the difference between 321,000 and the 308,100? Well, it's going to be 12,900. So remember, there's a credit balance, which represents net income in the income summary. We take it out of income summary and put it into retained earnings. Now we're pretty home free. I love this one because it's so easy. We just close out our dividends, which is a debit balance, and we close it out with the credit and put it into retained earnings. Okay. Let's try this problem. It's really good. What we're going to do is these are the accounts that we have at May 31, and we are going to record an adjusting entry for shrinkage, and then also prepare closing entries to close the balances of all those temporary accounts. Okay, so when we list them, here they are. Matter of fact, we don't need merchandise inventory right now, and well, we do. We're going to need it, retained earnings. But anyway, we take them and put them into our like a trial balance thing. So now we know what our debits and credits are. Okay, so if you read here, merchandise inventory still available is 718. We did a physical count and we have $718 worth. But notice here that in our records, we have 756. Well, why did it go from 756 down to 718? Well, because of shrinkage, like spoilage and theft. Okay, so we have to write that down. So how do we do that? We just reduce our merchandise inventory by $38, which is the difference between what we have now and what we need to have, right? So that would be a credit to merchandise inventory for 38. And then because we sacrificed our our asset, it becomes cost of goods sold expense. Okay. So I'm going to do a little bit of magic here. I'm going to pretend that we posted this, and I'm going to show you the effect on the accounts. So when I hit the button, it's going to post this entry, which means that merchandise inventory is going to be reduced by $38. And this 756 is going to become 718. Also, because we increased our cost of goods sold, this cost of goods sold expense of 2,100 is going to turn into 2,138. Are you ready? Hocus pocus, Mally Mocus. Boom, there it is. These are our numbers now, okay? Let's go ahead and do our closing entries. The first thing is R, close revenues and any other income statement credits. Well, if you look here, this is a asset, this and retained earnings and dividends, all of this. These two are, balance sheet. And really where the income statement starts is right here with sales. And man, we only have one credit in the income statement accounts. So that's what we do. We're gonna, how do we get rid of that credit of 3204? We're gonna debit it. That's it. Debit sales, 3204. Credit income summary, 3204. And we're done. That's the only income statement credit we've got. Now we do E, and that's close expenses and any other income statement debits. Okay, again, we have our normal cast of characters, depreciation expense, salaries expense, and operating expense. And we're going to credit those because it's a debit balance, and we close debit balances by crediting them. But also we've got some other accounts that are new because we're doing merchandising business. So we've got a income statement debit of cost of goods sold. And then both the contra sales accounts have debit balances. And so all of these debits, income statement debits, have to be closed. So here we go. Let's do it. So we list them, right? Just down the road: sales discounts, sales returns and allowances, cost of goods sold. That's the new stuff. And then we know how to do the expenses, right? So what we do is we have to put those in, and we build our entry. And then to figure out what goes into income summary, well, you'll discover that you won't know what that is until you add all of these up. And when you do, you plug and chug, and there it is, 3,318. Now, I'm not going to do the I and the D portion because it's exactly the same as the service business. The only difference is the R and the E portion, right? All right. Okay, I think we are going to do this one. So let me go ahead and end the show. And I guess I didn't even have to do that because I have it over here, I think. All right, what we're going to do is quick study 4-15 on page 183. Quick study 4-15, page 183. And I know that I'm going to be doing this kind of quickly, but because you guys are reviewing it as a video, you could always stop the video and write it down. Or if you don't understand what I said, you could rewind it and listen to it again. Okay, anyway, if we look on page 183, 15, we have all this information. Well, we know we're going to use that read, close revenues and all other income statement credits, and then close expenses and any other income statement debits. Okay, well, if you look, the only income statement credit is the revenue sales account. So, and sales has a credit balance. So to close it, we have to debit it. So debit sales, 170,000. Credit income summary, 170,000. All right, that's easy. Now, next one is E, close expenses and other income statement debits. Now, this is where it gets kind of interesting, because if you look, you see the answer here. You have the normal cast of characters, right? Depreciation expense, salaries expense, miscellaneous expense. And these are all credits, because we know that expenses are debits. And how do you close a debit? With a credit. So this is nothing new. What's new is you have to add the merchandising accounts. So that would include your cost of goods sold expense, which is normally a debit balance, right? Cost of goods sold expense is a debit balance. So we'll credit it. And we know that our two contra sales accounts are debits. So we close those with the credit. Now, like I was telling my face-to-face class, I said, even today, if you saw me at River Park and you asked me, well, what is the normal balance of a sales discount? I'd have to think, okay, well, sales is a credit, right? Because it's a revenue account. So then the contra sales account, sales discounts, would be a debit. You know, I've been doing this for probably 40 years and I still kind of do that. I do it really quickly, but I still do it. Okay. Well, anyway, once you get all of your income statement debits, and here they are, you add them all up, right? These are, like I say, these are income statement debits that we're closing. So that's why it's a credit. You add them up and all of those go into the income summary. Hence, I put that little box. I wanted to emphasize the fact that I'm plugging and chugging. I put these in, and once I do, I add it up, and then I know what to put on my income summary. In this case, income summary debit of 165,900. Okay. Let me work on this. Okay, the next topic is preparing a multi-step and single-step income statement. Well, let me tell you that the single-step income statement is what we're used to doing. It's the good old days where it's revenues minus expenses is net income. In the multiple step, as you're going to see, we include like cost of goods sold and gross profit, and we want to list all of our operating expenses and those type of things. So let me talk to you about this here. In a multi-step, it shows several steps in determining net income. And we definitely want to distinguish between operating and non-operating activities. And that will become a little bit more evident when I show you the example. And the single step, this is the one that we all know and love. Revenues minus expenses equals net income. Okay. Well, let's take a look at a multi-step income statement. You start out with net sales. And we know that net sales is you start out with sales less the contra sales accounts, sales returns and allowances, sales discounts, right? You add that up. And then when you subtract the contra sales accounts, you get net sales. Okay, so that's what that is. The next section is calculating gross profit. So how do we do that? Well, very carefully. Actually, we take net sales minus cost of goods sold is gross profit. Remember the first session, I think I wanted you to memorize that. How do you calculate gross profit? Net sales minus cost of goods sold equals gross profit. Okay, Now we have gross profit. Now we can subtract all of our other operating expenses. And this is kind of like the refreshments are us lemonade stand example I gave you, that, you have, what you're going to sell the lemonade for with the sales. And then what did the cup of lemonade cost you? That's your cost of goods sold. And the difference between what we sold it and what it cost us is gross profit. And from gross profit, we can deduct all of our other operating expenses. And in the refreshments are us example, it included, like, hiring your little brother to run the stand. So that would be wages expense. Or putting your stand in front of the bully's house and you have to pay him rent. That'd be rent expense. So anyway, you have all your operating expenses, right? You add them up. That's your total operating expenses. Then what we're going to do is take gross profit minus total operating expenses to get what? Wouldn't you expect this to be net income? Well, yeah, we're going to add a little more complexity. This is going to be called income from operations. And why do we do that? Well, there may be other sources of revenue and other sources of expenses, and they are revenue and they are expenses, but they're not related to the operation of your business. So as a manager, you want to know how much you made from the operations. So we're going to separate those other revenues and those other expenses. A good example is you earned interest, right? Interest revenue. Well, you're not in the business of, making interest revenue. It happens, but it's not part of your core operation. So you're going to put it under income from operations. It's below that line here. Okay. Or how about gain on disposal of plant assets? You sold some equipment. Well, you're not in the business of selling the equipment that you use in a business, right? But yet it did happen. So we're going to put it here. Same thing with the expenses. So when we net all the other revenues and expenses together, then we can we put that in here to get our net income. Okay. All right. Boy, I kind of jumped the gun here. So I'm going to go back up here. What are we going to do with this gross profit? Okay. Well, in like retail businesses and things, managers want to know the relationship between gross profit and sales revenue. So we have this thing called the gross profit rate. We're comparing gross profit to net sales, right? So gross profit divided by net sales would give us our gross profit margin. So like I say, we're just comparing gross profit to net sales. And what does this 31.3% mean? Well, for every sales dollar, we have 31 cents to pay for our other expenses, our operating expenses. That's how it kind of works. And like I say, the managers in the retail industry, they're really looking at that relationship between gross profit and the sales revenue. Okay, now again, let's go back and after we get our gross profit, I was talking about the operating expenses. You're going to take all your operating expenses against the gross profit, and that's going to give you your income from operations. And then after that, other revenues and expenses that you incurred or it happened, you earned, that it's not related to operations, is below this line, and you put those in, and that's when you get net income. Now, I do have other examples of non-operating activities, and if you're interested, you can kind of read all about it. But I've already hit the highlights there, so I think we're good. So anyway, once we net all that other revenue and expenses together, then we can come up with our net income. Okay. Now, this is what our multi-step income statement looks like in our textbook. And say, typewriter, it looks a little bit different. Yeah, it is. And what this does is just separates our operating expenses from selling and general administrative. Up to this point, up to gross profit, it's all the same, like I just showed you. But in our book, they want to separate operating expenses into selling expense and general administrative expenses. So notice here we have depreciation expense on store equipment. Why? Because we use that store equipment when we sell stuff. So it'd be under selling expenses. Well, what about depreciation expense under general administrative? Well, this would be like office equipment, depreciation on your office equipment. Like if in the back office you had a copy machine and you're depreciating the copy machine, it's not used for selling. It's actually for just administrative things like your accounting department and all that type of thing. So it would go here. So it's all operating expenses. I guess what we're doing here is we're giving the managers more information about the expenses. You know, you can say, well, yeah, I got total selling expenses of 42,100, and I got total general and administrative expenses of 29,300. So, and then once you do that, then you're back in business. You do total operating expenses, and then it's just like before, right? Gross profit minus your total operating expenses would be, again, income from operations. We're not going to do net income yet because we want to know income from operations. And we have some sources of revenue and expenses that aren't related to operations. So we put them below the line. So again, some of them would be interest revenue, gain on sale of building. And here we have some interest expense. And I do like the presentation, how they do this, because you can net them together and you can see the net of all the other revenues and expenses is really net revenue of 2,000. So income from operations, 12,900 plus the net, which would be revenue of 2,000. So now we're up to net income of 14,900. I do like that. I think the other one I showed you is a little bit more cumbersome, but I do like this. Okay, quick question. The multi-step income statement for a merchandiser shows each of the following features except, well, investing activity section, that's the cash flow statement. We haven't even done that yet. That's going to be chapter 12. So, but the multi-step will have a sales revenue section, a cost of goods sold section, and definitely gross profit. Okay. Now let's go to our single step. You got to love it. Revenues minus expenses equals net income. So notice here that when we, in our revenues, we'll have our net sales. But remember how we had those other below the line, you know, which is for income from operations. Well, we don't have income from operations. We're going to put everything under revenue. So interest revenue, gain on sale of building, everything goes in the revenues. Okay. So you don't see gross profit. You don't see income from operations. You just put everything in, all the revenues in one place. Same thing with expenses. You know, you will have cost of goods sold because it is an expense. You'll see cost of goods sold expense. And notice here that they didn't even expand on the selling expenses and general administrative expenses. You know, if this is for real, they would probably have a schedule somewhere that would break this out, because this doesn't give the managers and people that are interested very much information. But anyway, you see how it works. All the expenses, even the ones that go below the line, go below income from operations, it doesn't matter. We're putting them all in under expenses, because in a single step, revenues minus expenses equals net income. Now, we talked about the classified balance sheet. When did we do that? Was that last chapter? Maybe it was. But anyway, I just wanted to share with you that merchandise inventory is a current asset. And if you buy that inventory and you keep that inventory for over a year, well, brothers and sisters, you bought the wrong inventory. In a retail business or any merchandising business, you want that merchandise inventory to move. That's what you want. Okay. So it's going to be current. Now, I will tell you that current assets on the balance sheet are listed in order of liquidity. What I mean by liquidity is you're going to use up the asset or convert it to cash. Its ability to be used up or converted to cash. Well, cash is cash, so it's listed first. Accounts receivable, well, you're going to convert that into cash in probably like 30 days. You'll have like 210 net 30. So most likely, your customer is going to pay you within 30 days. And anyway, you go all the way down the line. Okay, so but I guess the punchline here too is you just want to know that merchandise inventory is a current asset. Let's go ahead and prepare a multi-step income statement and then prepare a single-step income statement. Okay, so here we go. What are we going to do first? We're going to panic. No, we're not. We're not going to panic. I know that's an old joke. Never gets old on me, though. Good thing I'm an instructor, right? Okay. What we're going to do is we're going to start out with our sales section. So we've got sales of 4512, less our contra sales accounts, sales discounts, and sales returns and allowances. We add that up. Those contra accounts, and then subtract it to get net sales. Then over here, we've got cost of goods sold expense. We put that there to calculate our gross profit. Okay. Now, what do we do next after gross profit? Well, we want to list our operating expenses, right? Now, in this example, we are going to separate those expenses into selling and general and administrative expenses. So let's start out with selling expenses, like sales salaries expense, rent expense, the selling space. If it was your back office, that wouldn't be, but it'd be like if you had a store, that would definitely be in the selling part. And then I guess store supplies expense, because it's part of the store. Advertising expense definitely is selling. And I think that's it. You list all of those selling expenses, you add them up, and that's your total selling expenses. Well, now let's do the general and administrative expenses. You've got office salaries expense, right? Remember, that makes sense. The office, your office people don't sell. They help do the accounting and all administrative stuff. So office salaries expense, 570. Rent expense, office space. See, that's different because now that's the office. It's not your selling space, it's your office space. That's going to go into general and administrative. And then office supplies expense, $8. Anyway, we add all of those general and administrative expenses to get the total of $650. Now, I don't see anything below the line, right? So I don't see any other revenues like interest revenue or gain on sale of, a truck or anything. So I think we're done. It's a simple example. We're just going ahead and take all of our total expenses of $1,740, subtract them from our gross profit, to get our net income of 997. All right, now it's time to do the single step. You got to love this. It's pretty simple. You have sales of 45. Oh, wait. Yeah. No, it's net sales. Look at that. That's what I was thinking. You're not even going to show all this detail. Just go ahead and put net sales of 4,227 here. Okay. And then what are we going to do? Well, that's the only, I don't see any other revenue. So I guess that's it. So then we're just going to move to our expenses. And what are they? It would be, the big one is cost of goods sold expense. That's one of the most important expenses that managers are going to look at, right? Because it represents how much your inventory costs you, what you had to sacrifice to earn your sales. Okay, and then you're just going to add your total selling expenses, 1,090, and then your total general and administrative expenses, 650. You add that up for total expenses, and then you gotta love it. Net sales, which is our revenue minus our expenses, would be net income of $997. Okay. The last topic that I'm going to teach you is a little bit of financial statement analysis. Not everybody is going to be, accountant. A lot of you are going to be managers, and you're going to have to use your financial statements to make decisions based upon those statements. Also, maybe you want to invest in a company. You better, know what you're looking at. Or maybe you're going to work for a bank and you got to determine, well, should I lend the guy money or not? It's going to be based on those financial statements. Well, one of the great measures of ability of a company to pay its bills, its current liabilities, is what we call the acid test. It's the acid test ratio. Now, the acid test ratio looks very similar to the current ratio. Remember, the current ratio was current assets divided by current liabilities. Well, in the acid test, this is even a higher standard because we don't include all of the current assets. We only utilize quick assets, which are cash based. So for quick assets, you would think cash, short-term investments that you could convert to cash readily, and then your receivables, and divided by the current liabilities. So it's a little bit higher standard. And if your company can pass the acid test, then you're all right. Okay. Notice here that we have JCPenney's acid test and current ratio. And notice that the current ratio is a little bit higher than the acid test. Why? Because in the current ratio, they're allowing all current assets, as compared to the current liabilities. But in the acid test, only quick assets. Okay. So if I'm looking at this, I'm pretty happy with this, with the acid test, because that means that, you've got like $1.12 to pay $1 of your current liabilities. But check this out. Oh, it's getting pretty slim. You don't even have enough quick assets to pay your current liabilities. I'm really pretty scared. But notice that we have the industry acid test ratio, and it's 0.50. So it's close. So I guess that should give you some comfort, right? Okay. All right. Then the next ratio that I want to talk to you about is one that we've already done. It's called, well, I call it the gross profit rate, but I think this book calls it the gross margin ratio. It's the same thing. It's used to explain profitability. Okay. Now, one thing that you have to remember when calculating this gross margin ratio, you got to know that sales minus cost of goods sold equals gross profit, because that's going to be the denominator of your ratio. And what is gross profit? It's the amount of profit from the sale of merchandise, right? So you sold a shirt for $30. It cost you 17, so you made a gross profit of 13, right? Now, that gross profit is what you can use to pay for your other operating expenses, and what's left over will be your net income. So managers and other interested parties closely watch the amount and trend of gross profit. So this is what it looks like. This is what your book says. It says the gross margin ratio equals net sales minus cost of goods sold divided by net sales. Okay, now I'm going to make it easy on you. What is net sales minus cost of goods sold? It's gross profit. So all you have to remember is gross profit divided by net sales. That's how we did it before, right? So why does this book do it this way? Well, it's because on your homework and on the test, sometimes they don't give you gross profit. They make you work for it. So you'll have to get gross profit. You'll have to go net sales minus cost of goods sold divided by net sales. So, if you saw me at River Park and said, hey, what's the gross margin ratio? I would say gross profit divided by net sales. That's what I do. But in this book, you got to know that net sales minus cost of goods sold is gross profit. They may not give you gross profit, so you got to be able to calculate this denominator. Okay, and what does that mean? It's the percent of dollar of sales available to cover other expenses and provide a profit. All right. So let's take a look at the application. So this is JCPenney again. The gross margin ratio, it's going good. It's going high, down, down, down. So, the managers are going to have to wonder, well, what is going on? Why is that? Well, it's rather that you can increase your gross margin by increasing your revenue. So you increase your sales price or reduce your cost, one or the other, right? But anyway, you as a manager, you'd have to figure this out. So in 2014, this just says that for every sales dollar, you've got 29 cents to pay for the other expenses, right? The other operating expenses, and to get your net income. So anyway, this is a good relationship that you need to know. All right. Hey, that does it for me. How about that? We're done. I'm going to stop the share. All right, guys, you have a good time finishing up chapter 4. And at this point, I'll just say happy studying. Bye-bye.